with Ask Annex. Got a question for us? Please go to our website, annexwealth.com. Look for the Ask tab. And as always, if we can help, click that Get Started button in the studio. Sarah Kyle, a wealth manager at Annex Wealth Management. Welcome.
Hi, Danny.
Matt Morzy is investment team manager and a CFP at Annex Wealth Management. Welcome back to you.
Hi, Danny.
First one is from James. This question is for Sarah. My year-end bonus needs to be invested in the market. Others have suggested DCAing. Others say invest now to buy quality companies that have growth potential. If I DCA over many months, I won't be buying on sale. First off, could you explain what DCA is?
Well, DCA is dollar cost averaging. And your question really depends on what you're trying to avoid, as Matt would say, and what your time frame is, and frankly, the dollar amount. But just given the current market and the pullback that we've had, I would suggest investing half of your bonus now and then spread the other half out maybe over the next 3 months. That way, if the market goes up, you have some invested, and if it goes lower, you still have that dry powder to add to the account. But it is important to have that disciplined strategy, and it's really hard when the market pulls back that folks tend to not want to put money in the market because they're worried it's going to go lower. So you need to be disciplined and keep that strategy in play. And nobody can pick the absolute bottom, but if you can get close and invest around the bottom, you will be well rewarded.
Yeah, and I always like to go back to the saying, is time in the market versus trying to time the market. Mathematically, studies would show that you just want to go all in at once, that it's going to provide the best returns over time. However, you do sometimes want to avoid that regret that you might have of putting money in and have seen the market go down right away afterwards, which you can't predict or time it yourself anyways. So if you feel more comfortable with spreading that out, then certainly having a plan and sticking to it is really important. But mathematics would say that you should just put it in today and let it go.
Question from Jake. What are your thoughts on active versus passive investing? Is there a place for both?
Yeah, there certainly is. And that's a lot of what we do here at Annex is try to blend those two approaches together. Active generally would mean that you have a portfolio manager trying to beat a specific index. Passive means you just buy the index itself. I think there's kind of a middle ground on that as well, too, that you could use a passive strategy, but in an active way, because it's always an active decision no matter which one you use. So maybe you like a certain segment of the market, whether it's energy or maybe dividend payers. You could find an index in those specific areas, which is a passive product or passive mutual fund or ETF, but it's an active decision to do that. So to me, that's kind of a hybrid, but ultimately you kind of want to blend those things together to achieve your goals.
Ask Annex. Next question is from Tate. Can you help me understand how to manage sequence of returns risk during retirement?
Yeah, so that kind of goes a little bit to that timing of the market standpoint from I'm going to retire today and now I don't have those earnings anymore to add contributions in. So I'm worried that the market's going to pull back and take away that retirement savings from me. What we have to remember is that retirement is often a very long time period. For many people, it's multiple decades. So you have a really long time horizon, probably longer than you think. Second thing, what we look at from an investment standpoint, I know we work really closely with our wealth managers and the financial planning team, is how are you going to control your cash flow during that time period? Do you have enough in cash to cover your next few months' expenses? Do you have enough of fixed income that if the market pulls back that you could pull from that instead of having to pull from equities that pull down? A lot of people refer to that as like a bucket strategy type approach, but we try to construct portfolios to be able to weather those storms so that you don't necessarily need to sell when things are down.
Yeah, and when we construct the financial plan, we do what's called a Monte Carlo simulation. So we retire you 1,000 different times with 1,000 different scenarios. And it really focuses on that sequence of returns and the different sequences of returns. So we are basically preparing you for the best of times, the worst of times, and somewhere in the middle.
I like that. Last question on Ask Annex is anonymous. How does Annex incorporate tax-efficient strategies into retirement planning for high net worth clients?
Well, every client situation is unique, but the goal is really to focus on the strategies that minimize taxes. For example, the asset location, when we talk about those 3 buckets, tax-efficient distribution strategies from the portfolio, leveraging that Roth IRA through Roth conversions or backdoor Roths, tax-free charitable giving with the qualified charitable distributions, using those tax-exempt municipal bonds when appropriate. And the nice thing is at Annex, we have credentialed experienced tax planners on staff at Annex, and we do all our own tax planning in-house.
Isn't it nice when a tax question comes up, we can just walk down the hall?
Yeah, it's great. It's so nice. It's such an advantage to have them right in-house.
Right, and the same thing with the investment team that Matt is a member of. If something comes up, somebody has a specific question. Matt, I've seen you actually in client meetings answering questions.
Yeah, I'm usually in a couple a week, which is an awful lot of fun for me to be able to go in and help people directly. But it really does increase that amount of communication that we have with our wealth managers to make sure that we're doing the right right thing for that client and for that unique experience that client needs as well too.
And while we're here, let's put a little plug in for the Annex Wealth Management SWAT podcast. You're a big part of that as well. That's every Monday, and you and other members from the team get together and talk about what's going on in the market that week.
Yeah, that's one of my favorite things of the week. We get together as a team to plan out what we want to say, how we want to do that. Yeah, we go through strengths, weaknesses, opportunities, and threats of the market. It's a lot of fun for us to do as a team, and we've gotten great feedback on it so far from clients and wealth managers alike.
And what's nice, it's a week ahead. It's looking ahead, and then we have that end of the week in review. So it's a very nice compliment to the end of the week show.
It kind of bookends, yep. Investment, retirement planning, tax planning, estate planning as a fee-only fiduciary. Know the difference? Our website is annexwealth.com. Click that Get Started button. Matt Morzy, CFP, Investment Team Manager, thanks.
Thank you.
Sarah Kyle, Wealth Manager at Annex Wealth Management, thank you.
My pleasure.